Saurabh Mukherjea of Ambit Capital joins us right now. Saurabh, thank you so much for joining us. It's been an alarming report from you, and some say a little alarmist as well. But you have pointed out that demonetization is going to have a very, very large impact on GDP in Q3 and Q4. More or less known now in the business media world, and it's been out there. But I'm going to actually focus on what do you think the government will have to do on the 1st of February?
I mean, look, we haven't said anything in the report which we haven't been highlighting for the last year and a half. A consistent thesis since the spring of 2015 was that Prime Minister Modi would bring about structural changes around black money, around attacking crony capitalism. Almost every theme that we thought would come through in spring 2015 has actually fructified. Our view was and remains that these changes will create short-term pain for long-term gain. Specifically, the cost of capital in India will drop sharply. We estimate that in the next 3 to 4 years, the cost of capital in India drops by 3.5 percentage points. That's the sort of drop in cost of capital we've never seen in the last decade or so. And secondly, the cost of land and real estate will also fall in our country. For those sorts of structural gains, some short-term pain is worth taking. In fact, some short-term pain is inevitable. So in that regard, I'm a little perplexed by the degree to which people are getting alarmed. There is no country in the world which has brought about big ticket structural change without taking some medicine in the short term, and I think that's the medicine that's been administered to the Indian economy this quarter. So that's the backdrop against which we wrote the report. With regards to your question on the budget, our view was, even before 8th November, our view was that on 1st February we would see something akin to universal basic income being announced. I think I remember highlighting this on your program the previous time we spoke to each other on Indo, that our reckoning was that universal basic income would come through in the budget. Something akin to that I still think is on the cards, especially given the sort of inconvenience that ordinary people have had to experience over the last couple of weeks. I think the probability of universal basic income being announced in the budget is that much higher. It also makes sense from a social welfare safety net perspective to install a safety net as we go through these massive structural changes in our country.
Mr. Mukherjea, when I think of black money, there are various sources of black money. One, of course, is the fact that you underreport your income and therefore you don't pay taxes, or you just don't report your income and therefore you don't pay taxes. That is one form of black money. Then there is one which is, of course, bribes. Now, in a country which is heavily oriented towards people who have contacts, people who can deal with government, and where a large part of Indian citizens are actually not full citizens. For instance, if you're a hawker on the street of New Delhi, then if the law is actually implemented, then you'll not have a livelihood. If you are a person working in someone's house and the law is actually implemented, you will not have a place to stay. So the role of corruption there actually is to just allow people to survive. It's low-level corruption, but that's the kind of space. A local cop, a municipality officer who has cash at home, that is going to dry out for some time. Now, that is a difficult thing to come back from. Even it's not a short-term pain. It's actually poison.
I think the way I've looked at the whole situation is that every economy adjusts. Ours is also a fairly flexible economy. Even if the economy were not fully remonetized, let's assume for a minute that for every 100 rupees that was taken out of circulation on 9th of November, let's assume only 70 or 80 come back, and then say there's a cash deficit of around 20 to 30 rupees. The economy will adjust to that. It's a matter of time. The economy adjusts to that. Digital payments, digital cash will play a much bigger role clearly in our country going forward, and hence the the paucity of cash, the scarcity of cash at the street level can be adjusted to. You just need to give the economy some time. This quarter's hit is what we believe is that this is a requisite time for the economy to broadly adjust. And then, from January, February, things start normalizing. I'm not so sure. A lot of people are saying that this is a longer term hit to consumption. I've heard several people say that this is a major hit to consumption over the next 2 to 3 years. I'm not so sure I buy into those alarmist stories. Right. My view is that this is a much more shorter term hit, specifically almost a heart attack for the economy in the current quarter, with the process of recovery and adjustment moving quite quickly forward from Q4 FY17 onwards, and then the year to March 18 we get to around 5.8% growth, which is fairly healthy, given that next year will also be our GST year, and potentially we could see an attack on Benami gold and Benami land next year as well. So given the sort of magnitude of the changes out there, I think the adjustment process is already under progress, and I think by this time next year, the bulk of the adjustment to an economy with less cash and more digital will have already been broadly done.
I'm actually making a very different point here, Mr. Mukherjea. I'm saying that you cannot have in India, you cannot get rid of low-level corruption, because a large segment of Indian poor survive because of low-level corruption. The state does not recognize their rights. The law does not recognize their rights. That is the point that I'm trying to make. And if you... sorry.
So look, I mean, I'm not the greatest expert in corruption, but I think corruption is a slightly different subject to cash. Corruption can be, bribes can be given in physical form, and indeed over the past week or so, we are hearing tales about bribes not being in cash anymore, but being in physical form. So I'm not so sure that either the poor's fate structurally. I'm not so sure that the poor are their poor's fortunes are structurally impaired by the reduction of cash in the country, nor am I sure that corruption itself melts away just because we have less cash in the country. Corruption can come in many forms, and more likely than not, corruption will morph itself if our country becomes a less cash and more digital payment oriented country.
The reason I was making that argument is that there is an argument to say that when you demonetize, reduce the amount of cash in the economy, you're essentially deflating it unless the frequency of transactions increase. What I'm trying to say is that if corruption revives, it will tend to suck out the white money even further. So while the RBI might reduce the amount of money supply, the fact that cash might actually go back into black, and with a reduced money supply, means that either the RBI will have to fill that up, or it has a recessionary impact, more than what is being expected right now.
So look, I mean, one of the reasons we cut our GDP growth estimates, and specifically for the current quarter, we said that GDP could well shrink in the current quarter. One of the reasons we did that was we do believe that in the near term, this degree of pullback in the currency in circulation, 88% pullback in effect in the currency in circulation, will be recessionary. So insofar as that is the case, I agree with you that you cut the currency in supply by close to 88% was the amount of 500 and 1,000 rupee notes. They put some of it back, but still the vast majority of the currency that was circulating around the country on an 8th November is not there. So it clearly cramps your space for economic growth in the near term. The point I'm making is, over a longer term, 2 or 3 adjustments play out. As we've said in our report on 18th November, we expect the RBI to cut by 25 to 50 basis points over the next 4 months. I think the Prime Minister too has said something along similar lines. Furthermore, it's highly likely that banks will cut rates very aggressively, even more than the RBI will cut. The banks will cut rates very aggressively, given the amount of liquidity they have. Thirdly, a fiscal stimulus in the budget on 1st February is highly likely. We discussed the universal basic income a couple of minutes ago on your show. And fourthly, the natural adjustment forces that people realize there is less cash going around. Let me switch to digital, let me switch to electronic wallets and see if I can carry on doing what I was. So various adjustment forces kick in. In the near term, clearly deflationary, clearly recessionary, as highlighted in our 18th November note. But the more you move away from the events of 9th November, the less pronounced the recessionary forces, and the automatic stabilizers in the economy kick in, and both the central bank and the fisc kicks in to give the economy a bit of a buffer.
Okay, you were kind enough. I remember I had this kind of an offline exchange with you, and you were kind enough to give some data to me about the amount of exposure that Indian banks have to the SME sector. Now, one of your points that you've highlighted is how the SME part actually is largely informal. It has a lot of interaction with the informal space, and their margins are dependent on not paying taxes. So you expect a lot of pain there. One of the questions that one would want to know is, and I understand that you're going to be coming out with a report on that, 17%, these are the numbers that I got from you, is Indian bank exposure to the SME sector, which works out to about 13 lakh crore. Total NPA right now is 6.5 lakh crore in the system that I could get. 75% of SME financing is either through themselves or through the informal system. Now, when you are affected in that space, NPAs could rise in the SME space. And that's a huge number. I mean, 13 lakh crore of exposure, which is kind of affected right now.
Yeah, look, I think in a way the RBI's announcement a couple of days ago that that borrowers with less than a crore outstanding will get 60 extra days to repay their money. I think in a way that's an implicit acknowledgement by the regulator that the SME sector is experiencing a cash flow crunch. So clearly, even the regulator understands that you have a problem this quarter, and perhaps the problem goes into, say, January, February. That I think is reasonably clear that in the near term you do have a cash crunch in the SME sector because of the RBI giving relief. The NPA hit is unlikely to materialize in the banks or the NBFC's books for the quarter ending December. The more interesting question is what happens next year. What happens as we go into calendar year 18? And our view there is that what you'll see in the SME sector is the informal end of the SME sector, which sort of doesn't pay taxes and thus generates black money, that part of the SME sector we think will gradually wind up because they realize that it's becoming increasingly difficult to function in India without tax, without paying tax.
You had already said that GST itself will affect that, right? Now there seems to be a double whammy.
So our expectation originally was, that's right, our expectation was GST would trigger that process, but in a way what demonetization has done is it's preponed the hit. So rather than the hit coming, say, summer or autumn 2017, that hit of SMEs gradually winding up their businesses as they realize they can't operate with full tax will come through quicker. Now the question, to answer your question, we know banks have 17% outstanding to SMEs. What proportion of the bank's customers will be affected by the wind-ups? So what proportion of banks' SME customers are actually not paying tax, thus generating black money, and thus will be looking at a wind-up over the next couple of years? Hard question to answer. We're actually trying to do a survey on this to get some grip on the issue. But my reckoning is it's the NBFCs who are potentially more affected by this. The NBFCs and the housing finance companies who are potentially more affected by this than the banks per se. The bank's exposure to NBFCs and HFCs is around 5-6% of credit outstanding, and it's through that route I think the banks have exposure to the SME conk-off problem rather than directly. In any case, thanks to the RBI, the hit won't be seen this quarter either by the banks or the NBFCs. We're looking at a Q4 event potentially, and even then it'll be a moving feast. I think over Q4 FY18, Q4 FY17 and Q1 FY18, we'll gradually see this SME hit as a large proportion of small SMEs decide that the best course of action is to wind up their business. NBFCs, I think, and HFCs are more affected by this than the banks specifically.
Okay, I'm going to come back to the employment impact of SMEs, a portion of SMEs winding up in just a second. But since you're talking about NBFCs, housing finance companies, how seriously are you taking this thing that the real estate space is going to collapse because of the fact that cash is getting more and more, and the fact that that Benami property issue is also now going to come into play?
I think a long time ago, July 2015, we'd written a report about the implications of what Prime Minister Modi's structural changes, the implications of that for the real estate sector. And back in July 2015, we had said that it's a little strange that we have a country where the rental yield in the big cities is around 2%, and the cost of borrowing is closer to 9.5%. And the two numbers are very far apart. It's very rare to find a large economy where the rental yield is so far away from the cost of borrowings. You broadly expect a degree of parity between the two numbers. If not absolute parity, you expect the numbers to be closer to each other. Now, as I just mentioned, we expect the cost of capital to India to drop quite sharply over the next 4 years. The SBI base rate, we reckon, could be closer to 6% in FY20 than the 9.5% it currently is. So that will be relief for home buyers. It will make homes more affordable for a big swathe of the middle class. But the other change, I think demonetisation will trigger. It's not the only source of it. There's a whole bunch of other changes. But the whole attack on black money will trigger a correction in real estate prices. I think a correction in real estate prices was already underway over the last couple of years. The process, I think, hastens and accelerates as the government becomes more strict about black money and as the government becomes more focused on cracking down on Benami real estate, Benami land. So it's a process. It's a correction. The process that was underway anyway, a real estate correction, and my reckoning is it carries on for the next year and a half as Prime Minister Modi's resets continue to affect the economy.
So is that good or bad for housing finance companies or for anyone who's in that housing loan space? The reason I'm asking that is that yes, volumes will go up, more people will probably find it affordable, but then if the size of the loan reduces, the loan book total loan book will also drop.
So most of the housing finance companies have three parts to their book. One is the classical mortgage, where someone like you or me takes a home loan, buys a property. I don't think the classical mortgage product in India is going to be that badly impacted by the attack on black money. The pieces that could be impacted by the black money attack are developer loans. Developers, I think, will face more of a challenge selling their property going forward than they have done over the last few years. Last few years, as it is, was difficult for real estate. I think the problems for developers accentuate going forward. So that part of the HFC's loan books could see repayment problems. And then more specifically, LAP, loan against property, where the HFCs have given loans to small businesses using with the small businesses factory or warehouse as collateral. And often those small businesses have cash flows which might not be white money, and that's where another layer of risk lies for the HFCs. Will those small businesses be able to stand up in a country where paying taxes, generating black money will be increasingly difficult to do? So the classical mortgage book of the HFCs, I'm not that worried about it. I'm worried about the developer books and the loan against property books of the housing finance companies.
Okay, I know you're in a hurry, but I have just two more questions for you. One regarding as you said, the cost of finance is going to go down, and you're saying that it's probably going to go down to about 6.5%. On savings bank accounts, you have that 4% return. Of course, current account, nothing. But if money which is stored, like we know that anecdotally a lot of women keep money in cash, which is coming into the system, that's unlikely to stay in the CASA space. That's probably going to go into fixed deposits. I know that it's slightly better for banks longer term, but that's a higher payout in terms of the interest payout. Now, the money flowing in, unless you can lend it out, is actually a liability for banks rather than an asset, right?
So yes, it could well be that in the near term, with this welter of deposits, the banks have too much liquidity. But barring the market-leading CASA franchises, which is say three private sector banks and a couple of big PSUs, barring the banks which are massive CASA franchises, even for the smaller banks, lots of CASA is good news because they can replace their wholesale market borrowing with CASA, which will cost them less. So even if the banks are not able to lend out money quickly, which I think is more likely, I don't think credit offtake is suddenly going to shoot up in the next 3-4 quarters. I think it will take a while for loan demand to pick up and credit offtake to shoot up. Most of the banks will actually benefit from that because they'll be able to replace more expensive wholesale market funding with CASA, which will improve the net interest margins. But I think the longer term story is very exciting here. I mean, we were putting in, if you use the government's GDP data, we were putting in something between $200 to $300 billion into real estate per annum, another $50 to $100 billion in jewelry. These are vast sums of money. Even if you assume that only a quarter of this gets directed into bank deposits, fixed deposits and CASA, you bring down the cost of bank funding radically over the next 3-4 years.
And also, I'm assuming that with money going into government bonds, then the government's cost of borrowing is also going to go down. Since you're in a hurry, I'm going to just go back to that original question about employment impact. Now, estimates are that about 46 crore people are employed by small and medium enterprises. A large part of it is in the informal sector. There are 10 crore small merchants. And I'll give you an anecdotal example of the person who I buy from, the corner shop. He doesn't even have a machine, a credit card machine. And he told me that 4% is my margin on low value products, 6% on high value products. If I get a machine, I'm left with 2 and 4%. So it just doesn't work out for me to be in this business anymore. Those kind of people are going to be badly affected, right? And that has a big employment impact and then a consumption impact.
So, Anand, I mean, I appreciate the near-term impact, but as I said, India will adapt quickly. So, to take the specific example of the Kirana store owner you cited, I think it was 2 months ago the NPCI came up with a unified payment interface, wherein you and the Kirana store owner can SMS money to each other. So you as a customer just need to download your bank's UPI app. The Kirana store owner does the same, and the two of you are then paying each other through SMS. The UPI doesn't cost anything as much as a POS terminal that the banks provide. So without cash, it is possible to transact with almost at every strata of society, provided the person has a bank account. Now, thanks to Jan Dhan, the vast majority of people in our country do have a bank account, and as a result, I think the adaptation from a highly cash-centric economy, where 85% of transactions were in cash.
I mean, they can hardly access it.
So provided...
I mean, right now our reporters are out there in rural areas, Mr. Mukherjee, and a lot of people are just simply not going to banks simply because it's a waste of 2 days of, just to go there, deposit their money, take it out, is 2 days of labor gone.
Yeah. Look, I'm not pretending that this is an easy process. All I'm pointing out is that the process of adapting to a country with lower cash, I think, is underway. It will continue. The country will adapt reasonably quickly. In that interim period, the economy takes a hit. On the longer term basis, a lot of SMEs who were operating without paying tax will find life increasingly difficult and will wind up. That does create a surge in unemployment. I think that's where the government's policies to create a social welfare net, a safety net, will become very relevant. And let's hope on 1st February that safety net is unveiled for the whole country.
All right. Thank you so much. I know you're in a hurry. Thanks a lot. This could go on and on for joining us. Pleasure talking to you.